Welcome to this video on bond investing basics. If you've already looked at the stock video, you will note that I definitely indicate that the use of individual bonds is an absolute no-no. And while bonds are supposed to be more conservative, well, no matter, it's still all about the risk. And the risk right now with a bond bubble, etc., that'll be explained, causes one to just try and figure out what's the best route to take and potentially how to do any asset allocation. Now, in the past one, we've talked about stocks if a company wants to expand, but then in that first sentence, they can also issue bonds. They're not selling away part of their company. They're just having somebody buy $1,000 bond normally, pay those people, and then when the maturity is up, they give them the front money back. The bonds are an obligation of the company to pay the interest rate due each year semi-annually, as well as the full value of the bond when it becomes due. That's called maturity. The interest rate varies on the length of the bond. It should be obvious, just like a CD. If the bond is only for a very, very short period of time, then they don't have to pay that much to get you interested because you're going to get your money back soon and there isn't, let's say, an awful lot of risk. But if you're going out 30-year bonds, you're going to be looking obviously at the term and the credit rating of that company. The best graded rating effectively in the world is the Treasury instruments. And you will see they don't pay very much over a long period of time, but by the same token, one does not have to worry at night if it's going to default. And the last one is what I've already gone through. The longer the time frame and the worse the rating, the higher yield is necessary. This is a very good graph to look over, 40 years or so in regards to what has happened with interest rates. But it is also a reflection of politics, and we might say once upon a time in the fairyland of economic supreme leaders and political empty heads, you had all sorts of people wielding their power as political leaders, and it's ended up with a mess that we're in right now. But let's say we, discount maybe everybody but Yoda, and see what are some of the people that are really trying to hold things together. And this is up the top, it says Fed leaders. And you should be aware of the names. I realize some of you may not be familiar with these, but it helps to put a perspective on who's doing what, when, where, and why. You can see that in roughly 1980, interest rates were going through the roof. Inflation was horrid, and you can't have that scenario last for a long time. Paul Volcker came in and really put the squash on rates. And as a result, he was able to get those rates to start to come down, hopefully on a permanent basis. Greenspan took over and had 20 years worth, and he was in the same position of trying to get interest rates and inflation down to acceptable levels. I mean, many years ago, it was indicated that they wanted to get inflation potentially down to zero. We'll discuss that in a bit. Probably, I would bow down to Greenspan every time I read something about him and so forth. But he made a mistake, if you will, allowing more derivatives to be utilized closer to the 2006, 7, 8 mess that we ran into, and some of the halo became somewhat tarnished. Yet he really helped to get the rates lower, Unfortunately, we did end up with a complete mess due to everything that went on. And subsequent to that, we had Ben Bernanke, from 2006 to 2014. I don't like to second guess, somebody that has the power of the Fed. I think, however, we should have let a few more companies go into default. But in any case, in order to get out what was going to be absolutely a major depression, the Fed pumped money into the economy to get things to kind of come back. Uh, Somewhere along the line, you had to have interest rates come back up because you can't have interest rates at zero. Supposedly, there's a comment coming up. So now we have Janet Yellen in there, who is indicating that the U.S. is doing so well that we may have, quote unquote, an opportunity to raise rates, but it's going to be a very, very difficult haul to figure out whether or not that's going to work. But there's, one other that's involved with this that you will hear about in dealing with the European mess is Mario Draghi, who's the president of the European Historical Central Bank. Anyway, how have bonds changed after issuing? This is critical to an understanding of whether you want to buy into a bond fund in particular. If you want to buy bonds and simply hold on to them until they mature, a lot of this is not necessary. But since I'm doing this still for the basic middle America, I'm going to tell you that buying individual bonds requires a huge amount of money. You have to have 30 to 40 in order to have a proper diversification, and that's going to add up to a lot of money because you just don't want to buy one bond here from this municipality and another one from this corporation. It tends to do with bond funds. But this is what the overall element is as to whether or not you're going to make money in bond funds or you're going to have to find some other way of getting decent income. First of all, look over to the left and you see 7.5%. Assume you went out in whatever it is there, 1974 or whatever, and you bought a 30-year bond paying 7.5%. Okay. Now, as a period of time has gone by, let's say from 74 to 84, in 84, the interest rates were then being offered to consumers at 15%. Okay? If you wanted to sell your 7.5% interest rate bond, are you going to get more or less than the face value? Well, think about it. A 15% bond is $1,000. A 7.5% bond, you're not going to get $1,000 for this. I'm making everything else equal, the ratings and so forth. So what happens is the value of a portfolio of bonds like this will go down. On the other hand, what has been considered to be a bond bubble, that'll show up shortly. But let's take a look at a scenario during a long period of time where interest rates have gone down. Let's assume you bought a 10% bond in 85, 86, and now later on you want to sell your bond. Forget about the time frame right now. Just allow me the latitude of saying that they're comparable entries. If you have a bond that's being sold in the economy now for 4% and you had a 10%, the value of your bonds would go up. There's not much to this. It's fairly straightforward. However, you can see all the dances that went on from 1980 and still going on right now to 2015. It isn't one straight line, but you can see the effort by Greenspan and Volcker has been to really bring down that issue. What we're running into here is now that interest rates are so low, are we going to, pardon me, is Yellen going to raise rates right now or not? Or is it going to be delayed 6 months? Or there's what we're running into. Eventually, however, there isn't much in getting away from the fact that rates will have to go up, primarily because if you run into bad times, you want to add money into the economy and reduce rates. Well, if rates were always already zero, you don't have an awful lot to work with. It really strangles the economy and the Fed. So anyway, what we've been talking about here is a big fat bond bubble, meaning if you bought something around the 80s, uh, as time has gone on, the interest rates have lowered and you were able to make money appreciation on the bonds because of that. Nothing unusual. I found that they worked very well until most recently. But the kicker is, again, what's going to happen if the bond bubble bursts? I mean, really, that is tough. I don't have an answer other than that there'd probably be a huge amount of turmoil all over again. And I don't know what the Fed or the European Central Bank would do to make things better because it's a pretty much a fabricated economy across the world. Now, here's a small graph, current, that shows that if you did wish to buy US Treasuries, I mean, these are the highest rated bonds effectively in the world, if you allow me. And you could go out and buy 5 year and get 1.5%. I got to tell you, that's not an awful lot of money. And that means that if you are charged a fee for buying those bonds, say it was in a bond fund, that would reduce that 1.5%. Now, if you go over to Vanguard and Fidelity has index funds, they're real cheap, real cheap. So are ETFs, exchange traded funds, they're real cheap. But are you paying an advisor at the same time for looking to the selection of something like this? And that happens to be, say, 0.5%. By the time you get through, you don't have an awful lot of money. And then if you have inflation, this is tough. But what you are looking at for those low rates, they are not going to skyrocket. Even increasing the rates is still going to demand that there's going to be low rates in bonds for some time to come. And I wouldn't be surprised it may even be a decade. And that's another term you may be hearing about, the new normal, that things are not going to regress to what they were before because it just ain't the same anymore. Now, I did say something that should be obvious, isn't it? That here's a 3-month Treasury instrument at 0.02%. Well, rates can't go below zero, can they? I lied. I mean, when they first brought this up, that some of the banks in Europe are actually charging rates below zero, or in other words, the depositor has to pay the bank for holding the money. Think about this. Does that make sense? Well, no. I mean, but everything is so messed up that it is pretty difficult to figure out what is going to work, when, where, and why. And you see, again, I just call them, these are totally fabricated economies where many of the rules of thumb, which uh, I usually state didn't work that well, but when times are good, but are pretty much useless now because things are so far out of whack. There's a couple of other things that you have to know about. If you went out and bought a bond, and we'll say in this case, you see the 10% is still there, you were able to buy a 10% bond, and you say to yourself, say, I'm going to be able to make a whale of amount of money on this because I picked the rates at an excellent point. Interest rates are still going to stay low and no problem. Well, almost all the bonds are going to be callable, which means corporations and municipalities can pay off a bond early if interest rates are going down. Well, you see, they're paying 10% to the consumer, and if bonds right then are being offered at 4%, they sure as heck would like to get rid of that 10% bond and then reissue something at a lower return. Well, there it is. If it's callable, now you will know the call dates because they have to tell you the call dates when you buy these things. The issuer does not have to call the bonds, but when you look at this simplicity here, you can see that's what they would do. Now, we're not going through this, but there's just a couple of things that I just wanted to show you. Look at Pennsylvania, and you see the BBB. Remember, that is a junk bond. BBB and below is a junk bond. You go down to the next arrow, you see there's a California, and that's AA3 A+. If you were to go over to the coupon amount, this is what's stated to be paid, you would find the junk bond is initially paying more, which they have to do to entice you to buy their bond, versus something that is far more conservative of the A+, which gets a 3% coupon. Again, when you're dealing with things that are higher priced or lower priced than what exists in the current economy, let's take a look at the black arrow. The coupon on that rate is 4.25. That's what somebody will get semi-annually. But the yield to maturity, I'm not going to do the yield to worst call in there. I'm just doing yield to maturity. But the kicker is, you're going to have to pay, instead of $1,000, you got $1,050 and 78. So you have to pay more for that bond, not only because of the rating, but because of the yield, et cetera, et cetera. Are there times when it will look different? And you can see in here that there was a 3% on Maple Heights, Ohio City School, but you can buy it for a little bit less because there's a concern about it. So they have to entice you with a lower price so that the yield to maturity would be better for you. I realize this is a lot at once, but that graph where I showed you, if rates go up, bond funds get hurt. If rates go down, bond funds do better. Bond funds, you don't have to worry about the calls and all that stuff because that's done internally with the bond fund. They keep buying and selling bonds as necessary. Now I put this in here. You don't have to look at all of it, but watch this in just a second. This says at the top, Moody seasoned a corporate bond yield, 367. Now kind of look at the arrow and just the last sentence before that arrow. This is lower than the long-term average of 7.24%. Think about it. Yields right now on this bond are half as much as the long-term average. There is very little consideration by anybody that rates are going to get back up to something like 7.24. They are going to stay low. What is low? I mean, everything is up in the air. Just pick something, but it's low. And you have to be careful, because if that's what you want to deal with, meaning bonds, you have to keep your expenses very low, because they really eat into your returns now, really eat into it. And if you've got somebody that's charging you 1% as an advisor, you're sucking gas big time. There's just no way out of this. So you have to be very, very careful in all the expenses that you're paying outside of what may be going on with the fund by itself. This is not something that I'm really having for discussion. I just wanted to show you a little bit how one might work with the other. You can see the blue line is the U.S. Treasuries, and they're real low. And you look at the green one, dark green in there. That's a corporate bond, an A-rated corporate. So you could see how one may compare to the other. There used to be obviously more variation because rates were higher, but they're so low, things get squeezed. The only other difference in here, and it's not shown obviously, is just I put something up higher there which says high yield. That would be triple Bs and below. It's nice to be able to look at those, but there's a lot of risks there. So what are the risks in using bond funds? It is true that bonds are not as volatile as stock. And now I'm really, I'll get a little ahead of myself, but I want to say bond funds are not as volatile as stock funds. And if there is losses, such as 2000 and 2008, they can hold down the total loss of a portfolio because they don't drop as much in bad times. They very well may do that now, but this is what happened in 2000 and 2008. However, when you look at the amount that stocks dropped, 44% in 2000, 57% top to bottom in 2008, there's not an awful lot of bonds are going to do for you. But we had returns that were good before, meaning that there were higher interest rates on the bonds, and interest rates overall were going down. So having a portion of bonds in your portfolio was a valid position. With bond returns close to zero now, what is going to be accomplished with the asset both in good times and bad? It's pretty bad all over the place, because if your bond fund isn't paying anything, why do you want to have it as part of your allocation when not only is it not paying anything, but the odds of it paying anything are pretty remote? And when you had a bad time, you may even lose just more money. You go from bad to worse. You have to think about that. Now, of course, what an advisor might say, and you've already heard this, well, we can't get anything with the T-bills and the corporate bonds. Let's go overseas. I'm going to tell you right now, you have to figure out what that risk is. Merely somebody saying to you, well, this is more risky. More risky means what? You can have your funds, your advisors should be able to show you the funds and numerically what the risk of loss would be in these. I'm not going to do it for this short video as an overview, but it can be done. It's something you have to look at, because merely going overseas without recognizing that risk, oh, no, no, no. And here's the main point that I've been making. If you have a portfolio allocation which had 30 or 40% bonds, but you're not going to get any gain on them now, it's the same thing as having cash with the possibility of potential losses. This is not a very good allocation now, but I believe you will still find this offered in many, many cases throughout the United States, because they may be using software that's 2, 3, 5 years old, something like that, where the idea that bonds had traditionally been a part of your portfolio, and so it's going to have to be that way now. Wrong. But we'll go more into that with the other videos that I have. The movement of interest rates and bonds provided good returns and limited risk to, I don't know, say 2012. Now all bets are off, really. It's just a tough game. I mean, stocks are not supposed to make what they made before, and maybe it's only going to be 5 or 6%, but it's better than zero. We have fabricated economies and an excessive level of risk as all try to figure out what to do going forward. It's all new. But with some rates below zero, one cannot expect high rates of returns for at least a decade. And even small increases will further hurt bond returns. The value of a bond fund will go down. And there's the other point. Add in high expenses on bond funds, you'll still find some of them at 0.75. Walk away, because that'll kill you with more losses. And if you have somebody charging 1% on a bond fund just to pick it, no. There's very, very, very little latitude now. I think this is apt. We're not in Kansas anymore, Toto. The risk factor for bonds has shifted. Their use in offsetting major losses might still work, but the reality of using a losing asset to do so makes little sense. And this has been Master Financial Education, and you may want to take a look at the daily commentary of D.F. Moody.